Welcome to our channel. If you find our content helpful, don't forget to hit the like button. This will be appreciated. Ever wondered how companies manage their finances? It's not magic, nor is it a secret language only understood by Wall Street gurus. It's all about financial statements. These are the compasses that guide businesses, the health checks that reveal the financial condition of a company at any given moment. Financial statements are critical to understanding a company's performance, its potential for growth, and the value it offers to its shareholders. They're like the EKG for a company's health, helping managers, investors, and analysts make informed decisions. In this video, we're going to demystify the three major financial statements: the balance sheet, the cash flow statement, and the income statement. We'll peel back the layers of each, revealing their components, their purpose, and how they interact with one another to paint a comprehensive picture of a company's financial well-being. Ready to understand the backbone of financial management? Buckle up. We're about to embark on a fascinating journey through the world of financial statements. Picture the balance sheet as a snapshot of a company's financial health at a specific point in time. It's like a photo capturing everything the company owns, owes, and the amount invested by shareholders. Let's break it down. The balance sheet is divided into three main components: assets, liabilities, and equity. First, let's talk about assets. This is everything that a company owns that has value. Assets can be tangible, like buildings, machinery, or cash in the bank. They can also be intangible, like patents or trademarks. Assets are what a company uses to operate and generate revenue. Next, we have liabilities. Now, don't get scared by the term. Liabilities are simply what a company owes. This could be in the form of loans, mortgages, or bills that need to be paid. Think of them as the financial obligations a company has to fulfill. The last piece of the puzzle is equity, also known as shareholders' equity. This represents the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. It's what's left over for the owners after everything else has been accounted for. Now here's where it gets interesting. The balance sheet is based on a simple but fundamental equation: assets equal liabilities plus equity. This means that what a company owns, its assets, is funded by what it owes, its liabilities, and what has been invested by the shareholders, the equity. So why does this matter? Well, the balance sheet provides crucial insights into a company's financial strength. It tells you how well a company is managing its assets and liabilities, how it's funded, and whether it's in a position to grow and invest in the future. Remember, the balance sheet is a snapshot. It's a moment frozen in time, showing you the company's financial situation at that specific point. So the balance sheet is the what in financial management, but what about the how? That leads us to the cash flow statement. Think of the cash flow statement as the company's financial diary. It's a record of the company's cash transactions, where the money came from, and where it was spent. It's the story of the company's financial journey, told through the lens of hard cash. First, let's delve into the definition of the cash flow statement. It's a financial document that summarizes a company's cash inflow and outflow over a certain period. Its purpose is not just to display the amount of cash a company has, but to show where that cash is coming from and where it's going. Now, the cash flow statement is divided into three parts: operating activities, investing activities, and financing activities. Each of these sections tells a different part of the company's cash story, so let's break them down. Operating activities involve the cash generated from a company's main business operations. This could include cash received from customers, cash paid to suppliers, and cash paid for salaries. Essentially, this section reflects how much cash the company's core business operations are producing. Next up, investing activities. This section involves cash used for investments in the long-term future of the company. This could be cash spent on purchasing property or equipment, or cash received from selling these assets. It's all about how the company is investing its cash to grow and expand. Lastly, financing activities involve the cash that flows between the company and its owners or creditors. This could be cash received from issuing shares or bonds, or cash paid out as dividends to shareholders. This section shows how the company is financing its operations and growth. Together, these three sections provide a comprehensive view of a company's cash flow. They reveal not only how much cash the company has, but also how it's earning and spending that cash. It's like peeking behind the curtain of a company's financial performance. In essence, the cash flow statement shows us the how of a company's finances. Now let's dive into the why with the income statement. The income statement, often called the profit and loss statement, tells us the why behind a company's financial performance. So what exactly is an income statement? Well, think of it as a financial report card. This document shows us a company's revenues and expenses over a period of time, usually a fiscal quarter or year. It gives us an understanding of how a company generates its income and where it spends its money, ultimately leading us to its net income or profit. Let's break it down into its key components. First, we have the revenue, or the total money received from selling goods or services. It's the top line of an income statement, and it's often why we hear it referred to as top-line growth, when a company increases its revenue. Next, we have the cost of goods sold, or COGS. This is the total cost it takes to manufacture or create the products a company sells. When you subtract COGS from revenue, you're left with the gross profit. This is the money a company has left over after covering the direct costs of producing what it sells, but before accounting for other expenses. Then, we have operating expenses. These are the costs associated with running the business, like salaries, rent, utilities, marketing, and research and development. They're necessary to keep the business going, but they don't directly contribute to creating the products or services a company sells. Finally, we have net income. This is what's left after all expenses, including taxes and interest, are deducted from the gross profit. This is the bottom line, reflecting the company's profitability after all is said and done. So, there you have it. The income statement is a crucial piece of the financial puzzle. It provides insights into a company's profitability, showing us how revenue is transformed into net income through the costs of doing business. With the income statement, we've now covered the why of a company's financial health. But how do these statements interact? Like individual pieces of a puzzle, these financial statements come together to provide a full picture of a company's financial health. To visualize this, think of the balance sheet, cash flow statement, and income statement as three musicians in a band. Each plays a distinctive role, but they all jam together to create a harmonious financial symphony. Let's start with the balance sheet. It's the drummer, setting the rhythm and providing a snapshot of a company's financial position at a specific point in time. It shows what the company owns, its assets, and what it owes, its liabilities. The difference between the two is the company's equity, the value that belongs to the owners. Then comes the cash flow statement, the bassist, holding down the groove. It's all about the rhythm of money coming in and going out, covering operating, investing, and financing activities. If the company is making more cash than it's spending, it's in a good groove. But if it's spending more than it's making, it might be time for a tune-up. Lastly, we have the income statement, the lead guitarist, stealing the spotlight with its flashy solos. It shows the company's revenues and expenses over a period of time, resulting in a net income figure. This figure then gets added to retained earnings in the equity section of the balance sheet. Now here's where the magic happens. These statements don't just play their own parts. They interact, they riff off each other. For example, net income from the income statement impacts both the balance sheet and the cash flow statement. It alters the owner's equity on the balance sheet and is a starting point for the cash from operating activities on the cash flow statement. Similarly, a purchase of a long-term asset will show up as a cash outflow in the investing section of the cash flow statement, and increase the assets on the balance sheet. Understanding the interplay between these statements is key to mastering financial management. After all, it's not just about reading the music. It's about feeling the rhythm, seeing the connections, and understanding the harmony. So, we've taken a journey through the three major financial statements. Now let's take a moment to reflect on what we've learned. The balance sheet, acting as the financial snapshot, shows us a company's assets, liabilities, and equity at a specific point in time. It's like a financial mirror reflecting the company's financial position. Then we dove into the cash flow statement. This is the financial diary that tracks the cash coming in and going out of a company. It helps us understand a company's liquidity and its ability to cover its obligations. Next, we explored the income statement. This is the financial report card, showcasing a company's revenues, expenses, and profits over a period of time. It measures the company's financial performance. Each of these statements provides a unique perspective, yet they're all interconnected, giving us a comprehensive view of a company's financial health. Remember, financial management isn't just about numbers, it's about understanding the story those numbers tell. Keep exploring the world of finance. Thank you for watching. If you enjoyed this video, please hit the like button and don't forget to subscribe to our channel.